I assume you guys can see on my screen.
Yes.
Okay. So today my topic, as NI, we often present different types of topic, from continuous improvement, from coaching, and today I would like to just touch a little bit on the finance side. It's one of my favorite topic. So today the topic is about understanding cash flow. Cash flow is used in many areas, from financial planning to equity valuations to project justification. So this topic today, I will touch a little bit on each of all of them. And to begin, is cash flow is one of the three financial statements a company providing in order to give a general understanding of how the company is doing during the quarter or during the year compared to the previous quarter and previous year. So the example that I will be presenting is they're using they are being prepared under IFRS, which is International Financial Reporting Standard. And there are two standards. One is IFRS and the other one is US GAAP, which are used mainly from the US company. So what is cash flow? Cash flow is just a net balance of cash moving in and out of a business over a period of time, from quarter or from a year. It can be either positive or negative. And generally, there are three types of cash flow when we look at the cash flow statements. One is from the operating, financing, and investing. Typically, cash flow from operating, you have, this is the part, or this is the one that you want to pay close attention to, is the net cash generated from a company doing a normal business. For example, paying goods, services, salary payments to employee. And the next one is financing. Financing cash flow is the net cash of a company to finance a company. This can include raising a debt or borrowing money from financial institutions. Also, they can raise money through equity in a public listed company. Example of financial cash flow is loan payment, dividend, and share buyback. Typical cash flow from financing is positive, but sometimes when they have a share buyback, it can be a negative. So the last one is investing cash flow. This is the net cash from a company investing related to sustain and maintain the operations. For example, buying physical assets, buying property or equipment to continue and to grow the company. So all in all, the purpose of the cash flow is to give a detailed reconciliations of company cash, how it's being used and how it's being expensed. There are two ways in doing cash flow. The first one is a direct method. This method are typically used by a small companies because it is actually recorded the cash inflow and outflow from a company operations. The drawback of this is very time consuming to list all cash receipt and payments, and sometimes it may not capture all the relevant informations. So the next one is indirect method, which is also known as accrual. This is the majority of the companies are using this, including the public listed one. The note is the direct methods are not recognized in the international standard or by a US GAAP as well. So indirect method, what happened is revenue is recognized when it is not, it is earned rather than it is received. So, and then also the expense is recognized when it is incurred. Typically, it will start with your net income, either it's profit or loss, and work its way down to adjusting all these different items. For example, your depreciation and amortizations and your current working capital. So let's take a look at the company I'm using over here is a mining company. It's a Teck Resources based out in Vancouver. As you can see right away, hopefully this is not too small for you guys. You have the first section is operating activities. The first two columns are reported on a quarterly basis, which happened to be the last quarter of the year. And the last two columns is the year ended, which is the annual from 2022 and 2021. So as you can see, under the operating activities, you have the profit for the period for the continued operations. In 2022, Teck generated about 250 million compared to 2021 is 1.5 billion. And then you can see it works its way down to depreciation, provisions, and different stuff, different type of stuff. And when you get to the net cash underneath, just before investing, you can see Teck for that period in 2022 last quarter, they have about $1 billion compared to $2 billion. And then moving on to investing, Teck spent a lot of money maintaining their property and their equipment. They spent about 1.5 billion for that quarter, and also they capitalized their stripping costs for their coal business. So all in all, in that period, the investing activities is they spent almost 1.8 billion. The interesting part is when you look at the financing activities, in that period they raised almost 100 million from their debt. And at the same time, they pay their old debt, which is above 100 million, 120 million. And also, Teck is a dividend-paying company. They pay some dividend regularly to their shareholders. And at the end, the net cash generated from the financing is a positive of 175. So when we look at these three sections, for that period, 2022, Teck actually has a negative cash flow of almost 700 million. So if we look at the overall of 2022, actually Teck has a positive cash flow generation of 313 million compared to last year in 2021. So what I want trying to say is overall in 2022, if you're looking at this cash flow, is first they generated a higher profit from operations, which is a main driver. However, if you look at the investing activity, they spent more than 2021 to maintain or sustain their operations. And at the same time, in 2022, there is activities of buying their shares and also repaying their debt, which result in a negative cash flow in their financing. So one thing to remind you is in some other financial report, I like Teck because they divided their quarterly accordingly in terms of their cash flow statements. But some other company, they like to lump it up. For example, in this current quarter we just finished third quarter, they lump it up to the 9 months period. So when you want to look quarter to quarter, you have to subtract for the last 2 quarters previously. So cash flow is essentially really important for a company to sustain and nurture and to grow, right? So when we look at cash flow, we also would like to see free cash flow. Cash flow essentially is your overall cash at the beginning plus your net cash is equal to your cash at the end. This cash at the end is being used in your profit and loss statements at the beginning of profit and loss statements. On the other hand, free cash flow, which analysts and a lot of people like to evaluate, is essentially a net cash from just the operations minus your capital expenditures. So it's equal to your free cash flow, which is it is a cash left over after a company has paid its operating expenses and capital expenditures. So money to spare. So in this, it can reveal what phase of the business in, whether it's rapidly growing startup, mature company like Tech Resources. It can also reveal whether a company is going through a transition or in a state of decline. So all in all, I want to provide a key takeaway for cash flow is it is possible for a company to be both profitable and having a negative cash flow. Negative cash flow can be as a result of poor cash conversions, preventing its ability to pay its expense, timely invest in asset to sustain the growth. And also, we have to recognize that profit statement does not include cash from investing and financing, so it's not able to see that. Similarly, it is possible for a company with a positive cash flow and increasing sale but fail to make any profit. So this happened a lot with the startup company and a scaling business to grow their business. Over here, I want to point out the difference. One item is between cash flow and profit. As cash flow for the cash flow, when you have a non-cash item like depreciation and amortizations, the cash flow exclude these items, and the profit actually includes it to arrive in your income tax pay, which is going to decrease it. So this is, I'm just highlighting the depreciation and amortization, which is being put back to your cash flow statement. So where do we use cash flow normally? We use cash flow in a lot of places. One is to fund the capital expenditures. The second one is the dividend payments. The third one is also cash flow. We can calculate cash conversion ratio, which is the amount of time between payment of inventory and receive payment for its good. So having a good conversion ratio, a high conversion ratio, meaning that you were able to turn your cash quicker. And the next two is the net present value and internal rate of return, which the project, when we are doing expansion in a company, they like to use these two numbers, the NPV and the internal rate of return. The net present value uses a lot of cash flow to arrive at the present value of your company using the required rate of return. And internal rate of return is just nothing more than making your NPV is equal to 0. So you want to know what kind of return you're getting from this NPV. Cash flow is also used to calculate your liquidity, to make sure that how well your company can meet its short-term financial obligations. The last one is cash flow is using for a lot of analysts to calculate a stock value or equity value going forward in the next month or in the next year. When a company earning is negative, they like to use P/CF ratio because most likely the company generating a positive cash flow. So ever wonder how analysts provide a stock equity value? This is just one of many model that they're using. One is to use what they call it a free cash flow to the equity. So free cash flow to the equity essentially is a leftover cash, including net borrowing, if you borrow money from the bank or financial institution, after the company has paid all its obligation, this including your operating expenses, including tax and interest, working capital investment, and fixed capital investment to sustain your business. Then free cash flow can be calculated using one of many ways. The most, I think one of the way that I like is the they start with the net income, and then they add the non-cash charges, depreciation, and then they minus all these expenditures. And plus the last one is they add the net borrowing if they borrow any money. So essentially, free cash flow is the money left over to be given as a dividend or saved in the bank for the future. So the model is the one I put out there is I call it the simplest one. It's FCFE, a single stage. You can have two stage, multiple stage. The stage represent a different growth in the company. So which is the G. So if you have a company growing quickly, the G factor can be higher. And then for the first 5 years, and then for the rest of the year, you can have the G at a lower growth rate. So quickly, if you want to calculate value of equity, you use the FCFE 1 plus the growth. The R is the rate of return that the investor, like us, are hoping to are demanding. What kind of rate of return? At this high inflation rate, the R is obviously higher because of the high inflations of high uncertainty. In this example, I'm using the required rate of return is 11%, which is including the risk premium, the inflations, and other stuff. So as you can see, the R is really sensitive to the variation. So this is one of the most challenging part for analysts to come up with the R, because you change a little bit of the R by 1%, it totally changed the value of the equities. So we understand, most of us understand that cash flow is having a strong cash flow drives company ability to growth and nurture. Essentially, there are 3 ways to improve cash flow. What I would like to use is there are 3 levers, right? One is we are looking from the revenue growth. Under the revenue growth, we have the volume and the price. Either you can increase the volume, is you finding new customers, if you are driving a new marketing initiative to get more sales, and also new products, if your company is making new products to get to the market. The other way is to do is if you increase price, which is harder, you're asking customer to pay for your goods at a higher price. So higher price on your existing product and higher price on your new products. The next lever is operating margins. We are looking at, under operating margin, we have COGS, which is cost of goods sold, and SG&A is just selling, general, and administrative. So under COGS, you have things to improve, like better contract with your suppliers, continuous improvement initiative, and automations. Under SG&A, we have payroll, we have overhead, and we have shipping and receiving. So on the last lever, we have asset efficiency, which a lot of companies trying to improve during these high inflations. Under the asset efficiency, we have PP&E, which is property, plant, and equipment. Under the PP&E, we have higher return on the assets. One of the example is OEE improvement, which is stand for overall equipment effectiveness. The one below it is if your company is holding a certain patent, which is proprietary technology. Under inventory, we have inventory management. We have buying efficiency, and then the last one, we have increased inventory turnover. Again, increased inventory turnover is the same as thinking of the same way as cash conversion ratio. So today, my topic, I'm trying to present to the audience is understanding cash flow, but at the same time, what we do ANI in the business is we provide a customer approach to understand and solve issues that directly impact companies' cash flow. The things that I highlight in the red box is the things that we have experienced and helped multiple clients in the past and in the present to drive the better operating margins or asset efficiency. Under operating margins, COGS, we have done several continuous improvement initiatives, which is, for example, Kaizen initiative or lean initiative. So our approach is always trying to link back to the company, other company in the stability situations, or is it a capability? What I'm trying to say, stability is if the company has a proper procedures, do they have a strong standards, and are there a lot of waste in the company? So we are trying to tackle those, what we call low-hanging fruit, before we move to the capability, which is trying to relate the to find the variables to tune what is your X variable that affect your output or the desired output. Under the asset efficiency, we also have experience in doing all this OE improvement and on the supply chain side. We have worked with clients to get a better contracts, to buying efficiency and inventory management. So I hope this provide a bit of explanation of the cash flow and how it links to our company. Thank you. Any question? Yes, I cannot see.
So I got to, okay. Asim, you want to go first?
Go ahead.
Oh, okay. Henry, great webinar. Very, very interesting. On your last slide, which I see there, you're showing how some improvements have an impact on cash flow. Have you actually tied those improvements to an actual financial number? We all know that, corporate people don't usually buy into some of the lean activities that we take, other than, where's the money, where's the profit, because their idea is always more short-term than more of the long-term approach. So have you ever used where conducting some of these improvements can actually impact your cash flow, and potentially by how much, or at least a ballpark figure? At least talk to them in a language that a lot of the corporate people really understand, which is money.
Yes, a great question, Angel. Actually, myself, I have not get a chance to do that, like linking the financial numbers to the initiative, because most of the time I stay on that technical initiative side. And at the time, it's also hard for somebody like me to get the financial numbers from the company that we are helping. So it's always critical to have those in the baselines. But I agree what you're saying is the short term is they're always looking at the cost and numbers without thinking on the long term.
Yeah, like there's no focus on the actual process.
Yeah.
That it may take X period of time and all the things we need to do to stabilize. Their objective is, what am I going to get out of this? And I thought able to equate it to something that they all understand, which is money. I just thought that there may be an opportunity there to kind of get them more on side with some of these projects. And I understand it'd be difficult to secure financial data. I mean, they're probably not going to give it up, but I'm just wondering, from your opinion, would that be very helpful in making things happen?
Yes.
Okay.
I agree.
All right. Okay. Thank you.
Hey, Henry, thanks for the presentation. Is there, I know maybe this is more a tax planning question, but do you have any comments when you're thinking of like office space, renting versus buying? How does that play into some of the metrics that you were showing, whether it's cash flow? Is there an advantage to having just a rent that is a monthly expense versus buying something and then selling it for capital gain later on? Do you have any comments on that world?
When they buy, because it's now is part of the investing, company tend to capitalize that property instead of you just renting, you just as expense, right? You write it off at its goes. When you capitalize it, you can depreciate it. So
you can depreciate it even though maybe you're going to sell it for a profit eventually?
Then you have to report the gain.
Gain, right?
But at the same time, when there are ways that company like to play, right? So the other thing that I forgot to mention is we also need to look at if the company have a higher number than usual compared to previous quarter on their depreciation. Are they trying to depreciate more now to show,
right,
oh, we have a bad number, and then but on the year end they have a much better number because they depreciate less.
Got it. Okay, great. Thank you.
Yes. Go ahead, Adam.
Yeah, thank you, and thanks for the presentation. So what are the suggestions you would have for maximizing the cash flow for a small business in general?
Small business. Any business? In general, okay.
A consulting business specifically.
I think we need consulting. It's sometimes it's really fluctuating, right? One thing to really look at the cash flow is we need to be aware of the cost. Maybe cash flow, like cash flow, if a consulting company sometimes had a trouble or sometimes have difficulty branching it out, then I think if to increase that cash flow, they might want to branch out. I'm not. Yeah, I think Carmen has a better.
Yeah, I'd like to jump into that conversation.
Yes.
I think Henry, you started it with what I was thinking as well, right? When you're a small business, the fluctuations are a lot bigger, right? We're usually the whole steady state is not there when you're a small business. So you got really, really good months and really, really bad months, and so cash flow becomes real. I mean, it's important for all businesses, Henry, as you mentioned, but for a small business, it could be more just because you don't have that smoothness that a big business sometimes has. And I think in my experience, not just of our own company, but other people I've talked to in the same situation, it's about controlling the cost element because you can't control the revenue element as well as you want. So it's really being strict with the expenses, right? What's the minimum you can get away with, so that you don't have this burden of having overly expensive monthly bills, whether it's software, whether it's real estate, whether it's hardware. I think those are my 2 cents, but Adam, you probably have the same or similar experiences.
Yes, thank you for that.
Good answer. Thanks, Cam. Angelo, yes.
Yeah, no, I just wanted to add to what some of the comments that Carmen made. With respect to small company consulting, I guess it's the ability to be flexible and nimble, because to try to level off the peaks and valleys is very hard to do. So it's always trying to keep those costs to a minimum. And if you do have some costs, have them flexible enough that you can mitigate any of the different changes in the business environment that takes place. Rent space as you need it, or have the ability to scale up or scale down with minimal contractual requirements placed on you, and keep the costs basically in line. And that's why, a lot of people subcontract out to other consultants. They're not on their payroll. They use them as they need them. So, anyway, good question. Good point.
Thanks, Angel. Okay, I think I have spent a little bit over from my time. So thank you all for joining for today's session. I'll see you next week, next time. Bye now.
Bye-bye.
Thanks, everyone.